The world of finance is often presented as a realm of genius, where legendary figures operate with near-mythical foresight. The reality, as revealed through a series of profound historical missteps, is far more human. Even the most celebrated investors are susceptible to catastrophic errors in judgment, often driven by forces they failed to recognize in themselves. By examining their most expensive mistakes, we gain an invaluable education, one paid for with their millions, so we don't have to pay with our own. The quest for a perfect, mechanical system in investing is a seductive but dangerous illusion. Benjamin Graham, the father of value investing and author of the seminal The Intelligent Investor learned this the hard way. He pioneered the crucial insight that a company's market price and its intrinsic value are not the same, as prices are set by emotional humans while value is derived from business fundamentals. This philosophy made him a giant. Yet, during the Great Depression, his conviction in his own analysis led him to disaster. After correctly predicting the 1929 crash and betting against the market, he assumed the bottom had been reached in 1930 and invested heavily once more. The market continued its brutal descent for 2 more years, wiping out 70% of his portfolio. Graham's story is a timeless reminder that no formula is infallible, cheap assets can always become cheaper, and intellectual frameworks must never override respect for uncertainty. A failure to manage risk can obliterate even the most spectacular fortune. Jesse Livermore, the man who famously coined the phrase buy low, sell high, lived a life defined by breathtaking risk. A natural skeptic and brilliant trader, he made and lost several multimillion-dollar fortunes by betting against the market, most famously during the 1929 crash where he amassed wealth equivalent to billions today. His flaw was an inability to step back. After the market hit its 1932 low, Livermore bet on further decline, only to be crushed by history's largest short-term rally. In a panic, he reversed his position, but the rally stalled. This final, unhedged gamble destroyed him, leading to poverty and ultimately suicide. Livermore's genius was undeniable, but his disregard for the fundamental shield of diversification proved fatal. His life underscores that talent without risk management is a blueprint for ruin. The temptation to concentrate wealth in a single, conviction-driven bet is a siren call for many investors, promising outsized rewards but carrying existential danger. The Sequoia Fund, one of history's most successful investment firms, built its legacy on concentrated, long-term holdings. This strategy served its shareholders phenomenally well for decades. However, its massive bet on Valeant Pharmaceuticals revealed the strategy's dark side. Initially, Valeant seemed like a winner, its stock price soaring as the company pursued a business model of acquiring drugs and aggressively raising their prices. Sequoia's stake grew to become its largest holding. When public and political backlash erupted over pharmaceutical price gouging, and allegations of accounting fraud surfaced, Valeant's stock collapsed. Sequoia was forced to sell its entire position at a 90% loss, evaporating billions in fund assets almost overnight. The lesson is stark: concentration can build wealth rapidly, but it lacks a safety net. When a concentrated bet fails, there is nowhere to hide. Emotional attachment is a silent killer of sound investment judgment, a truth painfully illustrated by an unlikely figure, Mark Twain. The great author, whose writing was powered by heart and humor, carried that same passion into his business ventures. He was an eager speculator, constantly chasing the next big thing, particularly inventions. He poured small fortunes into schemes like the Kaler type, funding inventors with boundless optimism but no contractual safeguards, and lost everything. These painful losses then clouded his future judgment with bitterness. When his friend arranged a meeting with a passionate young inventor named Alexander Graham Bell, who was seeking investors for his new telephone, Twain's past disappointments spoke louder than the opportunity. He refused, even when Bell offered shares at a discount. Twain's story is a classic case of emotions working in a double-edged way. First, unchecked enthusiasm led to poor due diligence, and then, the resentment from those losses blinded him to a historic opportunity. Setting predefined limits on investment amounts and adhering to logic, not feelings, is the antidote. Overconfidence often flourishes in favorable conditions, mistaking a rising tide for personal brilliance. Jerry Tsai, the first celebrity fund manager, became a star in the 1960s with an aggressive, fast trading style that delivered stunning returns at Fidelity Capital Fund. The financial media hailed him as a genius, and his confidence became his brand. However, much of his success was buoyed by a powerful, long-running bull market, the easy test that burnished his reputation. When market conditions eventually shifted, the strategies that worked in a steady climb proved less effective. Tsai's narrative warns against conflating luck and timing with skill. It highlights the perennial danger of believing one's own press and assuming that a winning strategy is invulnerable to changing environments. True skill is tested not in the boom, but in the bust. This pattern of self-assurance leading to disaster reaches its peak in the realm of pure overconfidence, where belief in one's infallibility triggers catastrophic decisions. The financial world is littered with examples of brilliant minds who, after a string of successes, began to trust their instincts over rigorous analysis. They placed bets so large that a single miscalculation could and did unravel everything. This arrogance leads traders to ignore contrary evidence, dismiss risk models, and ultimately make the kind of unforced error that is entirely preventable. The key to longevity in investing is not avoiding losses, everyone experiences them, but systematically minimizing self-inflicted wounds. This requires a disciplined process that controls for ego. Ultimately, the path to investment success is as much about psychology as it is about finance. The masters profiled here were not lacking in intelligence or information. They failed by succumbing to very human frailties, the quest for a perfect system, blind spots to risk, emotional attachment, and sheer overconfidence. Their stories form a masterclass in what to avoid. By studying their biggest mistakes, we learn to develop the emotional discipline, humility, and structured processes that protect capital. The greatest edge an investor can have is the wisdom to learn from history's most expensive tuition fees, building a strategy that accounts not just for the markets, but for the inevitable flaws in their own judgment.